Securities offered through Tj Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of Tj Stearns Incorporated. Trust, respect, and results. Tj Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, president and founder of Tj Stearns, Inc. Tim, always a pleasure. We appreciate your time, your insight, and perspective. Thank you for being here to help Chicagoland area savers and investors get perspective on the financial world and what we need to do with our money.
Peter, thanks for having me.
Always a pleasure indeed, Tim. And today going to be talking about a specific vehicle or investment option, a place where we can put our money that is really widely debated. There are pros and cons, I think, for every investment option. Banks, stocks, bonds, mutual funds, they all have things that they can do and then things that they don't do very well. But in this particular case, annuities probably are the one that are most widely debated. So, Tim, why are we hearing so much about annuities, and what do savers and investors who may consider annuities need to know?
Wow, that's a loaded question, but I mean, that's to lay it down easily. Well, first of all, annuities give you protection from the market, which right now we're getting a lot of phone calls from people that maybe have taken a pass on it in the past, saying I don't want that, the market's doing so great, and now they're coming back to the table saying, hey, we should talk about this, I want to learn more about it. What we do is then we educate them on exactly how an annuity works. One size does not fit all. We want to make sure that people understand what they're getting themselves involved in. But, there's a lot of haters out there that say that they're terrible products. And I hardly disagree, especially people like baby boomers. When we teach our classes, most baby boomers don't have access to a pension. Or if they do have a pension, it's from a long time ago, and it's not going to throw off much income. So these annuities can really serve that purpose, and it's perfect.
Tim, in these volatile and uncertain economic and market conditions, can annuities play a valuable role when addressing the question of what we should be doing with our money?
Well, in 1994, if you'd come to see me, I was just a stockbroker. And, my answer to you when the market was volatile would be, let's run into bonds. That was our flight to safety. Well, nowadays, bonds and stocks correlate together. They didn't used to do that when I first got in the industry. I would say 2008 is when that started. So if you ask me where the flight to safety is, where I can throw off an income that I know that is going to be guaranteed to you every month, then I'm going to have to say it's an annuity. The principal protected, you can make some of the money, not all of it that's in the stock market, but also the market's down, 20% like it has been this year. You don't lose your principal. And, my dad always said, it's not what you make, it's what you keep. And a lot of these people who thought they were stock jockeys and thought they were money managers suddenly because they had a 13-year bull market to fall back on are, realizing the reality that the market is not just legalized gambling and it's not a win-win all the time. You need to have something as a basis. The foundation of your retirement should be in something like an annuity that can't lose your principal.
Well, if you've got questions or concerns about your financial and investment choices and options, or how your investment accounts are performing, pick up the phone and give Tim Stearns, CFP, a call. He can run a portfolio analysis, a forensic financial analysis to uncover the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, and talk with you about reasonable options and alternatives. All of the financial tools available to CFP's certified financial planning professionals. Tim Stearns can help you review, weigh, and evaluate and make sure that you are appropriately allocated with your life savings. We are facing difficult economic uncertainty right now. A lot of people, I think, are reasonably concerned about what they are seeing in the economy and in the market, and that is being reflected in your account values, ladies and gentlemen. And if that does concern you, pick up the phone, take Tim Stearns, CFP, up on the opportunity for that complimentary, no cost, no obligation review and financial and retirement planning strategy session. 800-640-2256 is the number to call. That's 800-640-2256. 800-640-2256. So once again, Tim, every investment option has benefits and disadvantages, pros and cons. We're going to talk about both. We're going to highlight both. But let's start with who would consider an annuity? What can that annuity do that somebody would consider the annuity for? What are the benefits?
The benefits are for income. Yes, there are accumulation annuities out there that can do that as well. We do not do variable annuities with our firm. Variable annuities, one of the things that we say in class is they're mutual funds on steroids as far as fees go. So we use fixed index annuities, and fixed index annuities are principal protected. They would put out a certain amount of income depending on how long you've been in there, and of course how they perform. All right. So that is one of those are the positives. So when we're building an income allocation plan for someone and they want to shore up, they're going to get their Social Security, their spouse is going to get the other Social Security. They want to shore up what their income needs to be. This is where we do it from the income allocation, because it's a guaranteed income. And we always talk about this in our class and with our clients, that you have to work in the know when you're in retirement. What is the know? KNOW. The knowledge that you have enough money, enough income to cover your bills per month, so that when the market is being topsy-turvy and very volatile like it's been this year, in the Ukraine and all these the Fed raising rates are affecting your money in the stock market, you're okay because you don't have to lock in those losses by taking money out of the stock market. You can know that you have an income allocation plan, that the annuity is taking care of your income every month.
Principal protection and being able to avoid market losses during economic turbulence, Tim, that's pretty reassuring. But income protection, the ability to rely, count, and depend on a consistent income being there throughout our retirement, regardless of market conditions, that is really the paramount of retirement and lifestyle confidence and security.
Exactly. And recent studies have asserted that certain annuities are effective bond alternatives. So to that point, it's throwing off an income that every month you're receiving. Here's the best part. If there's a growth in the annuity, then the next year the payout goes up, right? So the money that the person's receiving in their bank account actually goes up, and they can't go back from there. So a lot of the people out there that poo-poo on annuities don't really understand them. And I'm good with people understanding them and then saying, no, I'll take a pass, but get educated. Ignorance is not bliss when it comes to this, especially when you're in the stock market that's being so crazy right now.
Well, Tim, you mentioned there are different types of annuities, some that you even mentioned you stay away from. But let's do a breakdown of those different types of annuities. What are the different types? And if you could, maybe give us a little synopsis of each so we get a better understanding.
All right, sure. So basically there's three annuities out there. Fixed, where they give you a fixed rate on your money per year, and that's what you're going to get. Rain or shine, that's what you get. There are variable annuities that can go up and down, all right, based on the stock market, and the incomes can go up and down. And a lot of times we found that the devil is in the details on those. And so we'll do MRIs, just like you do an MRI of your knee or your shoulder, and see what the fees are on there, and then what the amount of money that you can get out of there every year. Again, the ones that we like are fixed index annuities, kind of a hybrid of those two, the fixed and the market. It doesn't go into the stock market, but it will mirror it. And a lot of them have indexes now that can actually, go in and out of the market. They're a little bit more tactical. They weren't back when they started 25 years ago. They would be more mirroring the S&P 500. So if the market went down, you got a zero for the year. You didn't lose any money. But if the market went up, you captured some of that. Well, now we're seeing them do some good things with their performance. One of the companies that we use owns PIMCO funds. So we can use a tactical balanced fund to go in and out of the market. I like that a lot. There's different ways to get through retirement. For myself and my wife, it will definitely be an income allocation plan because I don't want to worry about the stock market. I want to know that my bills are being paid because I have money that's safe.
So, Tim, you talked about a fixed rate of return. You talked about the variables that are basically mutual funds on steroids. They are investments directly in the market and have risk. And then the fixed indexed annuity can participate in some share in the gains of the market without risking any losses to principal. Correct?
That is totally correct. So let's say the market's up 20%, you're not going to get all that. Okay. But more importantly, when the market's down 20%, you're not going to get all that either. One of my clients said the phrase, the zero is a hero, right? So when the market is down, like in 2008, 36%, those clients that were in a fixed index annuity didn't lose a penny. And that's outstanding. And so that's why I figure when you're doing an income allocation plan, that the next month you're going to be able to pay your bills, rain or shine.
Are there any additional features or benefits to annuities that we need to be aware of getting into them before we talk about what we may need to know for the drawbacks?
Sure. Some of them have, if you cannot do two of your activities of daily living, you can actually double your income in them to take care of you if you're going into a nursing home. Here's the best part. You don't have to show insurability. So even if you were terminal with cancer, you'd be able to use this, right? So, and you might have to wait a year to kick into that, but that's a great rider that they have on there that usually is free with the clients. So, you have to look at it, the full big picture. Now, there are some negatives to it. If you put money all into, you would never put 100% of your money into a annuity because it is locked up. The whole idea is that you're going to use it to get through retirement. If something, God forbid, happens to you, your spouse is going to use it to finish out retirement. Those are the great things. But if you put $1 million into a policy, annuity policy, and you want to get it out the next day, there are surrender fees, so you need to be wary of that. But a lot of them, the surrender fees go down every year. So after 10 years, if you wanted to walk away, you could do that. But there's a really good annuity out right now, an equity indexed, that you can actually turn on your income on the anniversary of every of the day that you put your money in there. Every month you can turn it on. So if you're seeing that you're like my brother got let go in his job, we had to move his timeline up. So these are things that we do for people. When you're doing an income allocation plan, they are dynamic. So we can go over exactly what an annuity does and what it can't do. And make sure that you make your decision with your eyes open, but do not sit out there and go, oh, all annuities are bad. That's not true.
Well, sounds like you listed several very beneficial qualities: protection of principal, protection of income, a lot of flexibility. It sounded like there, Tim, for when and how to access your money, although some limitations to that. And I've always heard that annuities are so complicated. It doesn't sound like there's a lot of complications with the types that you're describing, except maybe for that limitation on being able to access all of your money immediately.
Well, if you need to access all of your money, that's why you have a growth bucket with us that has stop losses. It's in the stock market. Yes, there's risk to it, but you have to have both parties to the game there, right? You have to have a fixed portion and you have to have an equity portion. Equity is the only thing that's going to keep up with inflation, as crazy as it is right now. But you also have to have something that's a base, a foundation, something safe that will pay your bills every month.
Again, we are talking with Tim Stearns, CFP. And if you would like a forensic financial analysis, a review of your investment and retirement portfolio, if you'd like to understand the risks that you are taking, the fees that you're paying, the taxes that you may be liable for, if you would like to construct that written income plan for retirement or address the performance that you have seen in any of your accounts, pick up the phone and give Tim Stearns a call for that complimentary review and retirement planning strategy session. No cost, no obligation. Similar reviews can easily go upwards of $1,000 to several thousands of dollars, especially with the design of the retirement income plan in writing for you. And at a high level, Tim addresses investments, income, taxes, healthcare, and legacy to make sure that your plan is complete. Again, if you'd like to take advantage, pick up the phone and give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, you also often talk about a reference book, a guide for retirement planning, income allocation, that talks a lot about the strategies that could help people address and alleviate many of the concerns that we're seeing with the economy and the volatile markets right now.
Yes, and that book is Income Allocation. It's an excellent book to figure out how to retire without all the stresses that people are having right now. 1 out of 10 of Americans have a written income plan. So this book, Income Allocation, spells out exactly how to get it done and properly get it done so that you and your spouse have a 30 plus year, try to get to that ideal retirement. If a lot of us don't have pensions, many of the baby boomers were introduced to a thing called a 401k in the 70s. And now they're getting ready to retire. And they're like, wow, do I have enough money? The market just went down 20%. Do I have enough to make it through here? If God forbid something happens to me, do I have enough for my spouse? So these are all things that go into an income allocation plan. And 9 out of 10 of us Americans are ignorant to that and do not have it.
Absolutely reasonable concerns, but also things that can be addressed through proper proactive planning. And if you would like that income allocation plan for your specific situation, custom designed for you, or if you would like the book Income Allocation that describes the methodology of planning and the specific retirement risks that can be addressed through proper planning, pick up the phone and give Tim Stearns, CFP, a call, 800-640-2256. That's 800-640-2256. Now, some of the strategies described within the book do work best for those who have been serious savers and investors. So that book is reserved for just the first 10 callers with at least 500,000 saved for retirement. But if you are concerned about your financial future, if you'd like that written retirement income allocation plan for part of your comprehensive and complete retirement plan, pick up the phone and give a call, 800-640-2256. That's 800-640-2256. Now, Tim, we've talked about the pros and the benefits of certain types of annuities. What do we need to know about some of the limitations or complications involved with annuities? What is the downside? What's the catch or the caveat?
So many times these income-based annuities are a 10-year product, okay? But if you're using it for income and you can turn it on during that 10 years, I don't see that being a problem if you're going to use it for income, and that's what we build in the plan, all right? The other part is that the two ways that you get credited that they use most of the time are a cap, like it caps out what the market does. So let's say your cap is 8%. And the market does 10, that year you'll get 8%. You will not get the full 10%. There's another way to do it too, which is called the spread. I like to think of that as like a hurdle, just like in track and field, right? And once you get over that hurdle, let's say the hurdle is 3%, the money is yours to keep in that portfolio. So those are the two different ways usually they get credited. And the last thing, depending on what's going on in the world, they have participation rates too, which could be anywhere from 60 to 100%, even more than that, depending on what the Fed does with interest rates. But these are all things that are disclosed to people. If someone opens up an annuity with us, they get an email from the insurance company, whoever we're using, that dictates everything I just explained so that people know exactly what they're getting themselves involved in. And then obviously it goes along with the income allocation plan that we're doing.
But Tim, if markets go down with caps or spreads or participation rates, we are not risking principal. So even if markets decline 10, 20, 30% or more, we may not have gains in the market to share in, so no positive rate of return, but we're still far ahead of where other investors with principal at risk would end up in those same scenarios.
Well, I mean, if you have all of your market in the stock market, if you have all of your money in the stock market, you have 100% at risk there, whether it's stocks, bonds, within mutual funds, et cetera, it doesn't matter, or individual holdings, they're all correlated and the market's going down. You could lose all of your money. Or let's just use this example. What if you lost 50% of it? How long do you need to get back to on track? We're not going to have another 13-year bull market to bring us back. So we need to be careful now. The difference being is that a lot of baby boomers in 2008 were younger and they still were plugging away at putting money in a 401k. Well, nowadays they don't have the time to make that up if there's a correction like that, and so you need to be careful and know that you're going to put your money into something that's guaranteed, the principal is guaranteed, and that it will pay out an income that you can't outlive because it's lifetime income.
So far, Tim, you've talked about the surrender charges and the period of time that you are within that surrender charge period, a penalty for early withdrawal, if you will. Some limitations on growth, but these are more comparable, it sounds like, to savings accounts rather than investment accounts due to the lack of market risk. So the caps, the spreads, the participation rates, probably all things that we need to know and be aware of. Also, you mentioned that there were some with simple fixed rates of return where we're not trying to share in the gains of the market. We're simply getting a fixed rate of interest. And are those improving right now with the improvement or the rising of the interest rate environment by the Fed that we're hearing so much about?
Yes. Believe it or not, the Fed raising interest rates only helps in CDs, fixed annuities, et cetera. It does not help us when we're going to buy a house with a mortgage, of course. But it helps for savers and investors. The flip side is actually better, right? So the CDs are paying out more, and then fixed annuities are paying out more. And then within the fixed index annuities, you can also put money in a fixed account, and that will be growing up too because of the Fed raising rates. And
so there's a silver lining to that, so to speak. Now, you mentioned that some annuities could be considered or are being talked about as being viable bond alternatives. I know bonds and bond funds and the fixed income component has been considered the more conservative side of the traditional investment allocation, and that 60-40 or 80-20 portfolio, those percentages that add up to 100 represent stocks and equities, and then bonds or bond funds or fixed income. You're saying that you agree that that bond or bond fund or fixed income side could actually oftentimes be improved by including some type of annuity there? Absolutely.
If you're looking for a fixed income alternative that is not correlated with the stock market and your equities, so not a bond, not an equity. If you're looking for something like that, then I would definitely look into the fact that you can put it in a fixed index annuity. And it'll behave just like a bond used to do in the 1990s when I first got in the industry.
So, Tim, if you would, give us a couple scenarios. What does that look like in an investor's portfolio if we are hedging some of that market risk, utilizing an annuity that is absent of or non-correlated with market risk?
So, I mean, if you have 100% risk and you lose, the S&P, let's say, drops 50%, you lose half your money, okay? So what I'm talking about doing is taking a portion of your money and putting into a fixed index annuity, not all of it, but enough to can throw off an income to help you make up your income gap. So what we do is when we sit down with people is we make sure that they understand they need, let's say, $100,000 and their Social Security is only going to add up to about, let's say, $72,000. They have a $28,000 gap every year. So how do they figure out what are they going to use from that? The stock market? Or they're going to use maybe a written income plan. So that's what I'm saying. A fourth of your money, let's say the market drops 50%, you've only lost 37.5% because only a fourth of your money a fourth of your money was in something principal protected.
Yeah.
Half of your money, then you're only losing, the market goes down 50%, it only loses 25%. Now people might go, oh, that doesn't happen 50% in yet 1 year. No, you're right. It usually does not. But what did it do in 2000, 2001, and 2002? It's 50%. And 2007, at the tail end there, through all of 2008 and a little bit of till March 2009, the market lost another 50%. So we need to be aware of our historic returns. So that's why I'm saying a great way to protect some money is to use an annuity so that you don't feel all the pain of the stock market going down.
Yeah, the average time from the peak to the bottom of a bear market is about a year and a half. It does not happen often within just a year, a calendar year, 12-month time frame. Oftentimes it spreads out even further, and it's sort of a slow bleed kind of scenario. Oh, the market's down 5%. Oh, it's down another 5%. Oh, it's down 10%. Is it time to pull out? Maybe it'll rebound now, and then it's down another 5 or 10%. And before you know it, a year or 2, year and a half has gone by, and you're down 20, 30, 40%. And that's why I think having a portion of your money that is principal protected and having all of the income need that you have in retirement also protected from market losses would be a very reassuring place to be in retirement. So what is your market protection plan, ladies and gentlemen? What is your income protection plan for retirement? That's what Tim Stearns can help you put together with that income allocation. If you would like to learn more, if you'd like an investment, a retirement planning review, and complementary strategy session, if you would like a written income plan for retirement, including Social Security, pensions, and distributions from retirement accounts, pick up the phone and give Tim Stearns, CFP, a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, we're told take more risk, take more risk, take more risk to get more returns. And it's not until the tide shifts that we realize that maybe we are inappropriately positioned and overexposed to risk. But it's not too late to do something about that.
Right. And that's why you have to look at what is your risk score? Where do you fall in at? We use a nice software called Riskalyze, and it dictates exactly what someone's risk is, and it shows them. What we're hearing a lot from people that have come over from other brokers is, they weren't hearing anything from them. No one was calling. One of the things I asked kind of facetiously in class is, does anyone have outbound phone calls from their mutual fund companies telling them to go to cash? And then everyone looks at each other like, no, I've never had one. So those are the things, silence says everything. Yeah. They're hamstrung too. They don't know what to do. So that's why I'm saying
that risk. If you're losing money, you want to hear from the resource that you're trusting, that you're paying to help you navigate these times and to provide proactive guidance and advice. And that's a big indication, ladies and gentlemen, if you are not hearing that proactive voice of reason and guidance of what to do in troubling times like this. So Tim Stearns is here on the radio each and every weekend on Protect and Grow Chicagoland Retirement. And if you've got questions or concerns, available to you anytime for your calls and for an individual complimentary review, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, we always appreciate the time. Thank you for being here to provide Chicagoland area savers and investors that guidance that they need.
All right. Thanks, Peter.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through Tj Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.